Modern portfolio theory, developed by economist Harry Markowitz in 1952, is a key concept in finance that helps investors create an ideal portfolio by combining different types of assets. Instead of looking at each investment on its own, it focuses on how various assets work together within a larger portfolio, especially considering their risk and return relationships. This approach highlights the importance of diversification and how different assets can balance each other out. In today's fast-changing and interconnected financial world, the theory remains valuable for businesses, investors, and individuals aiming to manage risk wisely. It offers practical ways to build portfolios that maximize returns without taking on unnecessary risk, which is especially useful for managing funds like corporate treasuries and pensions. This presentation will explore how modern portfolio theory works in practice, its benefits, and its limits, helping you understand its role in modern finance. Corporate treasurers apply modern portfolio theory to allocate surplus cash into a mix of investment options that maintain liquidity while seeking better returns. Large institutions like pension funds and insurance companies use MPT to construct portfolios that align with their long-term obligations, balancing risk levels accordingly. This approach promotes decisions rooted in data rather than relying solely on gut feelings or past performance, resulting in more structured and transparent investment strategies. Companies that effectively manage financial risk through MPT can stabilize their earnings, lower financing costs, and boost investor confidence, which supports sustained value creation. To put MPT into practice, investors start by defining clear investment goals, including target returns, acceptable risk thresholds, and time horizons. Then, they identify the range of assets to consider, such as stocks, bonds, real estate, commodities, cash instruments, and alternative investments like private equity or hedge funds. Finally, they estimate key factors for each asset, expected returns, risk measured by volatility, and how these assets correlate with one another, to build a well-diversified, optimized portfolio. This process is logical and accessible, even if more advanced investors use sophisticated tools to refine their strategies. The correlation matrix plays a key role because combining assets that don't move in the same direction helps reduce overall risk. From there, investors use optimization techniques to build the efficient frontier, which represents portfolios that either offer the highest return for a given risk level or the lowest risk for a given return. Investors then select the optimal portfolio based on their risk tolerance. Those who prefer caution may pick a lower risk portfolio, while others willing to take on more risk might choose a higher return option. Since markets and correlations change over time, it's important to monitor and rebalance portfolios regularly to keep them aligned with investment goals. The diagram illustrates this concept, showing the efficient frontier curve where the x-axis measures risk as standard deviation, and the y-axis shows the expected return, helping investors visualize where different portfolios fall along the risk-return spectrum. This idea from Harry Markowitz highlights that investors need to balance risk and return when choosing portfolios. The efficient frontier, shown by the blue curve, represents all the possible diversified portfolios that are considered efficient because you cannot increase return without also increasing risk, nor can you reduce risk without lowering expected return. Any portfolio below or to the right of this curve is inefficient. At the leftmost point is the minimum variance portfolio, which has the lowest possible risk by using diversification to minimize volatility, and it tends to attract more conservative investors. Another key point on the curve is the optimal risky portfolio, which maximizes return for each unit of risk taken. When combined with a risk-free asset, this portfolio becomes the main holding for rational investors. According to MPT, all investors hold this same risky portfolio, adjusting only how much they allocate to the risk-free asset based on their risk tolerance. In real life, pension funds apply MPT by diversifying across various asset classes like equities, bonds, real estate, private equity, and infrastructure to meet long-term goals while controlling volatility. Similarly, corporate treasury teams manage surplus cash by investing in a mix of short-term bonds, money market funds, and low-correlation equity ETFs, which helps reduce capital loss risk and improve returns compared to just holding cash. Platforms like Vanguard and BlackRock, along with robo-advisors such as Nutmeg and Wealthfront, use modern portfolio theory to automatically create diversified portfolios for their clients. These portfolios typically include a mix of global equity indices, bond indices, and real estate investment trusts, all selected to balance risk and return effectively. University endowment funds, including those at Harvard and Yale, also apply MPT principles on a large scale, diversifying investments across public and private markets, hedge funds, and natural resources. This approach has helped them achieve strong and stable returns over time. The advantages of modern portfolio theory include its encouragement of diversification, which reduces risk without necessarily lowering returns, and its use of quantitative, objective methods that remove guesswork. It's widely applicable, serving individuals and large institutions alike, and helps manage market volatility by focusing on asset correlations. Finally, MPT forms the foundation of many modern financial innovations, such as index funds, ETFs, risk parity strategies, and the capital asset pricing model. Modern portfolio theory has some important limitations to keep in mind. First, it relies heavily on historical data, assuming that past performance and relationships between assets will continue, which often doesn't hold true, especially during financial crises. It also assumes investors always act rationally, but in reality, emotions, biases, and group behavior can strongly influence decisions. Another issue is that MPT tends to underestimate extreme events because it assumes returns follow a normal distribution, ignoring rare but impactful occurrences like crashes. Additionally, correlations between assets can change over time. Investments that seem unrelated in stable markets may suddenly move together in downturns, reducing the benefit of diversification. Implementing MPT in practice can also be complex and costly, requiring large amounts of data, advanced software, and frequent adjustments, which might be challenging for smaller investors or businesses. Despite these criticisms, MPT remains a fundamental framework that has shaped investment management for over 70 years. Its focus on diversification, managing risk, and using quantitative methods continues to guide how investors build portfolios that balance risk and return. When combined with modern strategies and insights, it still offers valuable guidance to help investors deal with market uncertainty, improve performance, and create resilient portfolios that support long-term goals.